Hello investors and welcome to my YouTube channel where I study the best investors and businesses from around the world. Today we'll be looking at advice from the great Warren Buffett and Charlie Munger on index funds. So let's quickly talk about what an index fund is. This is a portfolio of stocks or bonds designed to mimic the composition and performance of a financial market index. It has lower expenses and fees than actively managed funds. It also requires a massive investment strategy. Warren Buffett to shareholders in his 1996 letter says, "Let me add a few thoughts about our own investments. Most investors, both institutional and individuals, will find that the best way to own common stocks is through an index fund that charges minimal fees. Those following this path are sure to beat the net results after fees and expenses delivered by the great majority of investment professionals." Warren Buffett. This is part of Warren Buffett's 1996 letter to shareholders. However, Ted Friedman from Cincinnati, Ohio, questions Warren Buffett about this 1996 annual report, and most investors will find that the best way to own common stocks is an index fund and charges minimal fees. 2 questions. Number 1, there are a lot of different index funds that hold different baskets of stocks. What criteria would you use or recommend to select an appropriate index fund? Number 2, the price-to-earnings ratio of the S&P 500 is significantly higher than its historical average. What benchmark should an investor use in purchasing this index? Buffett replied back and said, "Yeah, I would say that in terms of an index fund, I would just take a very broad index. I would take the S&P 500 as long as I wasn't putting all of my money in at one time. If I was going to put money into an index fund and relatively equal amounts over a 20 or 30-year period, I would pick one. I know Vanguard has very low costs. I'm sure there are a whole bunch of others that do. I just haven't looked into that field, but I would be very careful about those costs involved because all they're doing for you is buying that index. I think that the people who buy those index funds, on average, will get better results than the people that buy funds that have higher costs attached to them, because it's just a matter of math. If you have a very high percentage of funds being institutionally managed and a great many institutions charge a lot of money for doing it, and others charge a little, they're going to get very similar gross results, but different net results. I recommend to all of you John Bogle's couple of books. They're very good books, and anybody investing in funds should read those books before investing, or if you've already invested, you still should read those books, and it's all you need to know really about fund investing. He also added, "So I would take a broad index, but I wouldn't toss a chunk at it in any one time. I would do it over a period of time because the very nature of index funds is that you were saying, I think America's business is going to do well over a long period of time, but I don't know enough to pick the winners and I don't know enough to pick the winning times." There's nothing wrong with that. I don't know enough to pick the winning times. Occasionally I think I know enough to pick a winner, but not very often. And I certainly can't pick winners by going down through a whole list and saying, this is a winner or this isn't, and so on. So the important thing to do if you have an overall feeling that business is a reasonable place to have your money over a long period of time is to invest over a long period of time and not make any bet implicitly by putting a big chunk in at any given time. He gets to the second question, which asked, what benchmark should an investor use in purchasing this index? He says, as to the criteria as to when you should or shouldn't, I don't think there's any great criteria on that. I don't think the price-to-earnings ratio determines things. I don't think the price-to-book ratios. Price-to-sales ratios, I don't think any. There's no single metric I can give you or that anyone else can give you, in my view, that will tell you that this is a great time to buy stocks or not to buy stocks or anything of that sort. It just isn't that easy. That's why you go in on an index fund, and that's why you buy over a period of time. It isn't that easy. You can't get it by reading a magazine. You can't get it by watching television. It doesn't work that way. it's more complex business than that. It couldn't be that easy when you think about it. So if you're buying an index fund, you are protecting yourself against the fact that you don't know the answers to those questions, but do think that you can do well over time without knowing the answers to those questions. As long as you consciously recognize that fact, and if you're a young person and you intend to save a portion of your income over time, I just say pick out a very broad index, and I would probably use the S&P 500. I think if you start getting beyond that, you start to think that you should be in small caps this time and large caps that time and this kind of foreign side, and as soon as you do that, you're in a game you don't know. You're not equipped to play, and in all honesty, that would be my recommendation. So Warren Buffett says that if he were to buy an index fund, that it would be a broad index, such as the S&P 500, simply due to the fact that the S&P 500 is broad enough that it covers a wide variety of the entire U.S. economy. This means that by simply investing into the S&P 500, that your investment is going to cover a wide enough variety of the U.S. economy, that your investment is essentially going to reflect the U.S. economy itself. So if you believe that the U.S. economy is going to continue expanding into the future like Warren Buffett does, then investing into an index fund may be a good investment for you. Warren Buffett says that if he were to invest in an index fund, that he would not do it all in one time. He said that he would do it over a long period of time simply because he himself does not know how to time the market. This investing style is called dollar cost averaging. So by him putting his money in over a longer period of time, it reduces his risk of putting all of his money in when the stock market is extremely high. If a correction or a recession was to come after throwing all of his money in when the market was high, he could lose the vast majority of his overall wealth. So putting money into an index fund over time is essentially just a foolproof way of avoiding buying the peak of the index fund or the peak of the stock market. The second question answered by Warren Buffett at the beginning of the video is interesting. Is there a point where they would stop buying index funds? Currently, we're sitting at a PE ratio through the S&P 500 of about 24, and we're approaching a PE ratio of 25, which is considered to be very overvalued. And this question was asked by Buffett in 2002, but is very relevant to what is going on right now in the stock market. There are a few times in history where investing in an index fund would have given you a negative return for a long period of time. And yes, index funds over a long period of time do tend to continue rising, but there can be periods of about 20 years where an index fund can produce a negative return. Since the S&P 500 P/E ratio is about 25 right now, and the P/E ratios are continuing to go up more and more, money keeps flooding into the market. And since index investing is currently a huge wave that is going on in the investment world right now, it's worth looking into. No matter what the stock market is doing, if you just keep pouring more and more money into these index funds, then people buy an index fund like the S&P 500, what happens is your money is distributed throughout every company held within the index fund. So when everyone is continually buying index funds and just keeps throwing all of their money into them, the overall stock market keeps getting pushed further and further up. This sends stocks across the entire market up, which causes them to be considered quite overvalued. So is index investing still a safe investment? Well, index investing is not a bad idea by any means. Index investing has been a great investment, but there can be periods of over 20 years where you don't actually make a gain by investing in indexes. So there can be a long period of time where you can expect to not make any money by investing in indexes. This is also referred to as stagflation, which is a situation in which the inflation rate is high, the economic growth rate slows, and unemployment remains steadily high. So if you are looking into index investing, ask yourself, what are your financial goals? And what is the timeline to reach those goals? If you're someone young that has 30 or 40 years left of investing, then index investing very well could be the best investment option for you. But if you're someone close to retirement within the next 10 to 15 years due to low-term compounding effects, it might not be wise to continually put more and more money into the indexes. Keep in mind the rule of 72. The rule of 72 is a finance calculation that estimates the number of years it takes to double your money at a specified rate of return. If, for example, your account earns 4%, divide 72 by 4 and get the number of years it will take for your money to be doubled, in this case, 18 years. If you're the average investor, then you can just continually put money into index at the end of every single month. But if you're really wanting to delve into investing, you have to understand when to invest based on understanding when things are overvalued and when you should stop putting money into the market. By doing this, you can build up a big cash position that you can deploy when a correction or a recession comes, and you can invest that money when things are cheaper. It's unrealistic to expect the stock market to keep producing the same amount of gains that we have seen in the past few years. If you have 40 years, then index investing could be the best option for you. But if you're someone who has only 10 to 15 years left in the investment world and you are looking to make a substantial return on your money, a few fantastic Warren Buffett recommended books are Stay the Course, The Story of Vanguard and the Index Revolution, and John Bogle on Investing the First 50 Years. Here is the video from the Berkshire Hathaway meeting that this video is referencing if you'd like to hear more from the source. Warren Buffett's thoughts on index funds. So do you think you make the investment in the S&P 500, or do you think that individual stocks are the way to go? What do you think I should cover next? Let me know in the comments below. I hope you enjoyed this week's video. Please like and share this video and subscribe to my channel so that you can get updated on new weekly videos.